So let's get started. Here's a quick look at the agenda. Like I said, there's a few macro items just wanted to hit on, some of which may be moving around a little bit today with the Fed's meeting actually happening right at this time. Touching on some 24 portfolio themes, just a quick revisit of what we were thinking at the beginning of 23, just for some accountability purposes, going into our thoughts on stocks and bonds, and then more broadly to some things like alternatives after that. So let's take a look at some of the macro factors that are currently in front of us. This chart, I think it's probably well worn, but one that we'll probably continue to refer back to because it does provide, I think, a really broad gauge of economic health across both the services sector in the US, which is roughly 70% of the economy, and the manufacturing sector, which is roughly 30%. And what I think tripped a lot of people up this year and maybe going underweighting their equity exposure, which, as many of you know, we never do that and stick to our target equity ranges for clients' portfolios. But the really an interesting thing happened over the course of this year. You can see here, manufacturing has been in recessionary conditions for the better part of now going on probably 12 months. Because remember, any reading under 50 indicates recession. Any indication of over 50 indicates expansion. So the yellow line's been in contraction the whole time, and that's really confounded a lot of folks, really probably making them be a little bit too conservative than they likely should have been. But what's always given us some comfort is that the services sector, which is, again, the largest sector of the economy, has been pretty reliably in expansionary territory for the better part of the whole year after a dip in Q4 last year. Not really seeing a lot that's going to change this dynamic. And in fact, we could see a slight uptick in manufacturing sector, which would also be welcome news, because then you'd be working off a pretty established and strong economic base. The yield curve is definitely worth putting some time into or understanding what's going on there, because it's been pretty consistent the entire year, where we've had an inversion of the yield curve, meaning that short-term interest rates are higher than long-term interest rates for the better part of the entire year, which started to move this direction at the middle of last year. And by any indications, this will be the longest that the yield curve has been inverted since they started keeping track of this. One thing to point out, of course, is shorter term rates have been pretty established around these levels, especially the 3-month, 1 year, really reflecting a very staid hand with the Fed over the short term. But you can see the blue line, which is the 2-year bond, and the 10-year bond yield, which is the green, have really been selling off more recently, starting in late October, reflecting the fact that the market now expects the Fed to cut interest rates as we move into 24. And we think, as we'll talk about in a moment, that's just a really big assumption to make, and one we're not willing to make at this point, at this moment. This chart right here is kind of a different look at the 10-year versus 2-year bond. You can see, again, throughout the whole course of the year, even like through Silicon Valley Bank and then thereafter, the 10-year has been yielding less than the 2-year. And again, this would be, I think, in normal operating environments, a more reliable indicator. It's really been confounding that a recession actually hasn't hit for a lot of folks. And I think we're starting to come to the conclusion that with underlying economic data combined with stimulus excesses still working their way through the system, that this is becoming less of a reliable indicator, one that we should be paying attention to, of course, but maybe attaching a little less emphasis to. And then the big question, I think, that's on the mind of a lot of institutional investors, but ours as well, is what is going to happen with inflation. And certainly we've got a forecast based on consensus estimates, so we're not necessarily willing or able to put out our own internal forecast per se. That's really more of an aggregation of consensus. But what you see here are two things. One is the month-over-month CPI. So you can see we started January of 21 at below 1.5% inflation, peaking in May, June of last year at 9%. And now we've made our way back down as of last week to 3.1% on the month-over-month headline inflation. This orange line, though, is really, I think, the one that makes the most impact on asset prices, because it shows the rolling 12-month average, right? I mean, how much over an extended period of time are consumers experiencing price increases? And this is a really important, line to get an understanding on, because as we go down in inflation over 12-month rolling periods, markets start to pick up, both on the stock market side and the bond market side. We've showed that chart before, and I'll show you here in just the next slide. But just a brief recap as to where we think things are going. Likely, with energy prices remain muted for the foreseeable future, that's likely going to lead to numbers in the coming months that show inflation below 3%, but then potentially reaccelerating as you can only send energy prices so low, especially when food prices are continuing to rise, rent prices are continuing to rise. There's only so much juice you're going to get out of the energy trade. And I think this is estimated to be when it's going to wear off, and a reacceleration, although nothing that would generate a catastrophe. This is that study we were talking about. It's a really, I think, important one because Capital Group, it's the manager of American funds, put it together. And you can see we're right at average inflation right now, somewhere between 4.7, 4.8. Month over month, of course, is lower than that at 3.1. But you can see once we move below the 6% number, that's exactly what you would want to see markets spring back to life. And interestingly, when markets got over on the way up, when inflation got above 6%, that's about the same time that the market started to experience trouble within equity markets and started going down. So I think it was like March or April of last year, of 2022, is when returns started to get negative. So assuming we can stay within these bands here, from an inflation standpoint, it should be pretty accommodative conditions. Just briefly looking at what we thought would happen for 23, because we definitely want to make sure we're having some accountability. And I think a few things have worked in our favor. A few things certainly didn't, but didn't necessarily hurt us too badly. One is that still having some idea that inflation would be a little bit longer, or here for a little bit longer than the market expected. That would play increasingly negative to bond yields and bond returns. That certainly played out in 22. 23, that was the case up until a couple of weeks ago. But we still think, bonds have got some risk on them on the long end, and that longer duration bonds have limited utility. And actually, long bonds this year have not been a great place to be. Those are still negative, the 20-year and out. So maybe celebrating a little bit of a win on that one. No man's land. Certainly, I think we had a little backward where transition in the first year with the back half that was positive. And I think it's going to be the exact opposite, where positive first half of the year for Q1 and Q2, with the back half of the year kind of flattish, which is, I think, what's exactly going to happen, where you've got Q3 negative returns of about 4% or so on the S&P, and Q4 should be pretty positive. We'll see exactly where it's going to land, but kind of the exact opposite here. But 6 in one hand, half dozen the other. I think it kind of played out a little bit as the expectation, and not a significant decline like many were forecasting. This one, I think we got a bit wrong here, where higher risk parts of the fixed income market were actually a pretty good place to be. So high yield bonds, REITs, preferred stock, actually not REITs, but high yield bonds and preferred stock actually ended up being a pretty good place to be from a performance standpoint in 2023, really because the recession did not hit. So this is one I think we were wrong in. Hindsight being 2020, of course, but this is something that has worked out. We'll see, because 2024 looks especially treacherous for these types of markets, high yield bonds and preferred stock, because they're trading at levels that are very tight to treasury yields. They call it the spread. And with such low spreads, that just indicates there's some complacency setting in. And then finally, some alternatives to stocks. And I think this is another one we got, I think, right here, is that not only in the bond market, but also in alternatives marketplaces or asset classes, those have experienced some pretty good returns this year versus maybe prior periods. Moving to 24, I think it's a little bit of a similar setup, but there are some nuances here, where you've got a supportive economic fundamentals. You've got inflation that's moderating or declining over time, and you've got interest rates fairly stable around current levels. So that tends to be a pretty good setup for returns. But just a reminder, we're not necessarily going to make too big of changes or decisions with regard to our portfolios as we approach the election season. It's obviously going to be very acrimonious. Going to be a lot of debates or discussions about what could be the outcome. But I think the key thing to keep in mind, as we'll show in just a minute, is that markets are very rarely influenced by political decisions. And as long as you've got a separation of House and Senate or executive branches where it's not all one party, that tends to be the best situation for markets. And this could be wrong by the time this presentation is over, but our thoughts coming into today at least are that the Fed being on hold does not mean we're in the all clear position. And, I think there's a lot of market prices that are indicating people are really banking on the Fed cutting rates sometime in the first part of 2024. I think that would be a really bad decision for the Fed to do if, in fact, it was for the wrong reasons, if it was for political reasons or other, because I can't think of another time in history when the Fed would be cutting rates with an improving economic fundamental situation. It just doesn't make any sense, because it would lead to I think some dysfunction in the markets. So, but never say never. That's possible. And I think the one that's really giving a lot of people consternation here is this: when is this actual recession going to hit? Certainly, we would have thought it would have hit sometime this year, but that's clearly not the case. And I think rather than trying to make some sort of forecast on it, we're going to be relatively neutral in our positioning as we approach, potentially recessionary conditions, not taking excessive risk in areas we don't need to, but also maintaining an invested posture, so we're not missing out in the case that it ends up being this soft landing scenario. So looking at the asset class ratings, we really haven't changed much here. We still have kind of a neutral rating across equities with a little bit of a preference for mid cap. That has kind of made its way into most all of our portfolios. And we do think there is a potential catch-up trade between the largest companies in the US from a technology and everything else. And mid cap would be, I think, we think it's a really good way to play that catch up. Still have a preference for developed markets over emerging markets. China in particular looks like things are getting worse relating to their real estate sector. And that's just one area of markets we feel like we can avoid pretty rationally without having to fear that we're missing anything. Bonds still have a preference for short duration investment grade, government bonds, municipal bonds, all making sense right now on a tax equivalent basis. Still have not as much of a preference for the higher risk parts of the bond market, but if yields get higher, we'll certainly get more interested. And then, finally, on the liquid alternative side and private alternative side, conditions continue to look pretty good for returns in those areas. Across strategies that we manage, most of those strategies have had a pretty good go of it in 2023 and 24, with interest rate volatility continuing to be high and market volatility low. That can be a pretty good combination for returns on the alternative side. So let's look at what the stock market picture looks like for 24. So this is just a view of taken from State Street, the sponsor of Spider's ETFs. This is just a look at, I think this left-hand chart is kind of the key one here to look at, which is what's the consensus view of earnings in 2024? Because if the multiple doesn't change, then what this is saying is that if we stay at an 18 times earnings in the S&P, earnings are expected to grow in 24 by roughly 11%. All things being equal, if we have no change in multiple, the market should be higher by 11%. That's not necessarily our forecast, but because we do think the multiple will come down potentially a little bit, but even if it comes down just a little bit, there's still some room in there to offset any compressing multiple with growing earnings. International markets are a little bit on the lower end of growth expectations. You can see Europe only expected to grow 6% in earnings. Japan actually reaccelerating a little bit, up 8%. Emerging markets always holding the promise of double-digit growth, but of course that earnings growth comes with a lot of strings attached. And then just one reason that we're staying out of small cap area at the moment still has to do with this fact that earnings estimates now are being cut pretty decently, from at one point 6 months ago about 17% growth. Now they're only at 8%. That's a pretty dramatic revision. And so we're still reserving judgment on if we're going to have any small cap exposure or not in the future. So, but I mean, punchline here is for the markets that we will and likely have exposure to, S&P continues to remain the best growing area with the least amount of revisions. And I think it's going to be one of the better places to be for 24. We still have to address, I think, what is an issue in markets, and that is a significant amount of concentration in market structure, meaning that technology sector in particular, but also the Magnificent Seven are comprising much more performance than the S&P on average. You can see that deviation from the S&P is now at a level we haven't ever seen since you started measuring. And some might say, well, this time is different, and we all know those are very dangerous words to utter. But I do think rather than maybe expecting any sort of market catastrophe or crash in the Magnificent Seven, what's likely to happen in 24 would be more of a flattish performance for those companies as they continue to grow earnings. The valuation comes down for those companies, and they maintain a kind of a flat performance profile. Whereas there could be other parts of the market that perk up in price, and you can kind of see that here. So the forward earnings multiple for the S&P is at 18.7. This is as of 12/8. As a whole, the S&P equal weight, however, this is if you were to weight every single stock equally, so roughly 20 basis points or so, then the multiple is a lot lower. So this does away with the concentration aspect. So what we think could happen is the broader S&P multiple could come down a little bit, while at the same time the equal weight multiple could come up a little bit, which means that everything else outside of the top seven could be rising in price while the top seven kind of stay flat. That's kind of our go forward base case here, kind of removing some of that concentration. Here's another chart showing small cap underperformance if the line is moving up. This starts at 1990, by the way. And it just says if the line is moving up, that means Russell 2000 is outperforming the S&P. If the line is moving down, that means the S&P is outperforming the Russell. And I think really one of the key indicators for us to get much more excited about small cap is when the line starts moving up and in a less volatile and more predictable way. That'll be, I think, a nice signal to get more exposure or to start our exposure in small cap. But for right now, we still will reserve judgment and not necessarily have any exposure. Before when anyone makes any forecasts, I think it's always incumbent on the forecaster to know what everybody else is thinking. So this is a year-by-year look at consensus price targets for the S&P and then how those ended up. Obviously, these are fun to poke holes at because it seems like no one ever gets it right. But directionally, I think is where these can be useful as a directional indicator, not necessarily a spot on indicator. And I think what the consensus is expecting for 24 is S&P to end the year at 5,068, which is roughly 9% from the closing level on the 8th when we put this together. And I think that actually that does make some sense to me, because if we get 11% in earnings growth and the multiple comes down by a couple of percentage points, that way you arrive at a 9%. That makes some sense to me. So very conceivable that is within the realm of possibility for sure. Just a little bit of a word on presidential cycles. We are, in a presidential election year, so certainly don't want to minimize that. It's likely to be a more volatile year than previous years. So certainly want to make sure we outline that ahead of time. But this is kind of a look at a typical 4-year presidential cycle, going back to 1928, reflecting the first year, second year, third year, and fourth year of a term, showing, of course, how President Biden's terms have ended up so far. And that's pretty coincidental that he's landing, the performance of the S&P is landing right on top of the average of the last, almost 100 years. But I guess the takeaway from this one, at least that I have, is that we've got a bit of a upward bias still in front of us, that it looks pretty less volatile than potentially other periods in the last 3 years, because we had, of course, 21 and 22 that were significantly volatile and 24 could end up being less so. I think in one chart, if we had to summarize, why we're staying away from emerging markets in particular, I think this would be it, and why we still favor international developed versus emerging markets. And that is just this idea that inflation rates inform how a company or a country is growing. So if there is positive inflation, it generally means that there is underlying growth in the economy. And if there's deflation, like China has right now, that means that there's some things that need to be accounted for. Well, what's happening in China right now is their real estate crisis is starting to grow, and there will be fewer and fewer options for China to address this down the road if they don't start taking action on this soon. Some would say, and one action they did take already was helping support two of the largest property developers in China, Country Garden, and the other one escapes me at the moment. But nonetheless, with such price impacts on the real estate side, that's leading to broad-based deflation in the economy, and that just sets up for a really nasty downward spiral for asset prices within China in particular. So not too dissimilar to what happened in the Depression era in the 30s in the US, or 2009-10 in the US as well, as related to our real estate issues. China is now facing a very similar dynamic, and it's likely, because the size and scale of their real estate sector is so big, it's likely going to take many, many years for this to work itself out. So we'll stand on the sidelines and watch how this all evolves. I did want to point out, that over the course of the year, with rates moving higher, that has impacted or influenced some of the rates that we're seeing in the marketplace today. Some more so than others, but generally rising interest rates is good for people that are, looking to invest in bond markets, because your starting yield helps inform a lot of what your total return expectations should be. And it's, now the aggregate bond index has gone from 3.9% at the beginning of the year to 4.4. That's a pretty meaningful uplift of around 50 basis points. Only one sector actually going down in yield. That's international bonds. And then municipal bonds going up roughly 30 basis points or so, from 3.1 to 3.5. Not to minimize here, opportunities are, starting to pop up in certain parts of fixed income world. However, we're still going to keep our duration and credit sensitivity relatively low, because if we do end up finding some financial issues down the road with relationship to a recession, then all these high yields won't really be that meaningful. This is the chart that's likely changing in real time here as we're giving this discussion here. But this is in our mind the biggest difference in maybe what we think versus what the market thinks, and it's in those differences where real money is made or lost. And what you're seeing here is a summary of the Fed's what they call dot plot. And the dot plot is nothing more than each member of the Federal Reserve's estimate of where the Fed funds will be at various points in time. So at the end of 24, end of 25, 26, and so on. And then the market-based expectation is this black line right here. This is the Fed funds future. And as I point out here below, what is interesting about this setup is that if in fact the market is right, that would mean every Federal Reserve governor is wrong. And I think there would just be more discussion to have around that big assumption, because that it is a big assumption to make. And unless this dot plot really changes dramatically, then I think we're going to be in for some adjustments to be making within bonds in particular. Not us, but the market. And again, one of those big assumptions that the market is making is for rate cuts to be coming in early 2024, based on that previous chart. And so you can see here's a chart starting in 1990 through the 8th, or I'm sorry, through the 11th. And it just shows that we've been in a downward channel for bond yields for the better part of 30 years. And it would be really unusual for a change in trend, meaning this going from COVID era 50 basis points up to 5%. It'd be really unusual for this change in trend to not continue to go in the direction that it just came from, given how long it's taken interest rates to get down to zero. So, and there's a variety of reasons for why we think it could, be pretty, like, this is the 10-year bond, could be pretty supported at these levels, whether it's, we've got a lot of supply coming online due to budget issues. Foreigners have definitely stepped back from buying US bonds en masse like they did previously. Inflation could be here for longer in certain areas than the market is expecting. And then, of course, political dysfunction, this whole governing with continuing resolutions is never a good situation if you can't pass a budget. So all these little chinks in the armor of the U.S. sovereign bond market could lead to some, levels that are around here for some time, if not a little bit higher over the intermediate term. And that's probably one of the biggest areas that we would likely diverge from our peers. So just some key takeaways, and then certainly if you have any questions, drop those into the chat. But I'll try to summarize what just laid out for you in that, certainly that the 2023 rally surprised or surpassed our mid-single digit expectations. There's no question about that. However, our positioning for 23 was was not lower in equity exposure. So even though the forecast didn't occur, our positioning actually allowed us to benefit from that overshoot, if you will. But we think, 24 will likely start to see some, resumption of gravity taking hold in some parts of the market, particularly some of those magnificent 7 stocks. Because, stocks prices are just much harder to justify when you're paying a lot more for them at the start versus what might be some higher interest rates here to stay for a little while. We'd reiterate now is a great time to be thinking about trimming back some of those magnificent 7 stocks. Some clients may have noticed we've trimmed, I think the best company in the S&P this year was NVIDIA. We've owned that for our single stock strategy. We've trimmed that position now 4 times over the course of this year. And, I think that's just the right approach to go about managing risk in positions that maybe have overshot temporarily to the upside. The other one was, bonds are starting to transition a little bit in their meaning for our portfolios for liquidity and income, not for necessarily price or capital appreciation, as some like to have that as a bond mandate. I think it's still too early to celebrate this and slaying the inflation dragon. And there's more opportunities in bonds to consider, but longer duration is not one of them. And then finally, alternatives have remained a pretty nice diversifier over the last 2 years. Liquid strategies, I think, have demonstrated a really nice diversification benefit for those accounts. We've been able to implement those in. Same with private markets as well. And we see similar conditions setting up for those positions into 2024. So one question, actually, thanks for this question. One question was, given that you outlined some of the opportunity set for international companies, in particular international stocks, why have any international company exposure at all if you think U.S. is going to have better earnings growth and things of that nature? It's a great question. It does come down to a confidence level of outperformance in versus maybe what you can see in the data versus what actually happens. So I think there is some aspect of it that we don't know 100% if that's going to be the case. And so having a small position in international, as maybe some know we do, is the right answer. And I think that's reflected in our smaller position size. So just to give everyone a sense here, for an equity portfolio, right now our current positioning is 85% is in US positions. 15% is in international developed market positions, so Europe, Japan. And by reference, the global benchmark for stocks is roughly 50-50, so we're well underneath that global benchmark. Other question here or observation here is kind of a macro view on next year expectations. Well, those are certainly a bit tricky to uncover. I think we did review some of them, but from a macro viewpoint, I think growth still looks to be relatively well supported in the U.S. in Europe, for that matter. China obviously is having some issues with their growth model, coming under pressure with deflation and the impact that the real estate market's having. So that's a big variable, I think, to the outlook for next year. So hopefully that addresses that. From like an inflation perspective, I think the market is expecting that inflation will drift a little bit lower, maybe around these levels. So 2.5 to 3.25, 3.5% for maybe the first 6 months, with a little bit of a resumption back higher towards 4% in the back half of 24. That's, I think, what the market is expecting. It's some participants are not reflecting that, and I think there's some some variance we can take advantage of on that front. I guess is bringing it all home how it relates to what we just discussed. We still think having a mid single digit return on U.S. stocks makes sense. Interest rates or bonds, we still think having exposure to bonds makes a lot of sense when you can earn 4 to 5% in ultra short bonds. Right now, that makes some good sense from a risk and return standpoint. And then, liquid alternatives probably sit somewhere in between stocks and bonds, so maybe a little bit higher, 5 to 6. And then, private markets, that's still a big question mark, but we still think there's lots to do on that front. Hard to give a broad-based answer, but we still think there's a lot to do on that side. Another question that just came in: any initial thoughts on unchanged Fed's funds rate? Thanks for that question. That's exactly kind of what I was getting at here in this dot plot, which is with the economy growing, at a 2 to 3% clip, that's not catastrophe by any means. For the Fed to cut rates, generally they are trying to preserve that interest rate cuts for a situation that is really dire, where something is really wrong. And honestly, right now there are a lot of smaller things around the edges that look like they could be problematic down the road, but nothing is really wrong like right now. Like potentially earlier in the year, Silicon Valley Bank going into receivership, that was something going really wrong, but the Fed stepped in and supported that kind of workout process. So the Fed would, I think, really risk losing a lot of credibility if they were to cut rates right now, because if they, and what's the problem with them losing credibility? Well, then the market becomes unhinged from an interest rate expectation, and then your interest rates on the long end start to go up a lot. That's where that becomes really problematic. So unless there's something that's breaking or really ugly that's right in front of us, the Fed will likely not cut rates, and I think they can't, because they're backed into a corner at the moment with inflation relatively steady and a strong economy. That's just not conditions to cut rates. So hopefully that answers that question. Thank you so much for joining us. We look forward to bringing you more updates in the future. For those that are investors in our private funds, we will have a private market update, I think in early February, early to mid February. So stay tuned for that. In the meantime, I think we'll do one more 2 minutes podcast before year end. And before year end, I just wanted to say have a great holiday season, and I look forward to speaking to you at some point in 24. Take care, everybody.